Hello everyone.
Bonjour.
So this is day 2 of OPM, Other People's Money. And it's an exciting series. It's something we really enjoy. And why do we enjoy it?
Okay. I was like, you just stop there. I'm like,
We really enjoy it. Let's enjoy the moment.
yes, we're just gonna have
A moment of silence for OPM.
No, but one of the reasons why we enjoy it and it's so important for our business is because it's the one way where we can grow. And there's several different kinds of OPM. And today
Yes.
we're talking about.
Seller
I
financing.
thought he was gonna do a weird silence again.
Vendor take back.
Yes, owner financing. There are several different ways, but sometimes you can negotiate when you're purchasing a property that the seller holds financing for you, which means
Yes. So they can hold a first or second mortgage. Most of the time it's a second mortgage, second place. So you get a mortgage with a bank and then they're going to hold the equivalent of the down payment. So that does require some creative financing. You need to work with a qualified team of experts to do this. Oftentimes it's more like a credit union. Not really the big 5 banks don't really see very favorably to vendor take backs, but it's more local companies.
But there is a lot of advantages. Like for example, if you want to negotiate certain things, but you're willing to do the vendor take back with the owner, there are a lot of advantages for them in the sense that first of all, they are spreading out the
capital gains over a few years,
and they're probably going to make a little bit more money because you're going to pay interest on the amount that they're keeping as the VTB or owner selling. So if they're doing 20% of the purchase price as a VTB or owner selling, then they're making, and let's say it's $100,000, they could be making 5 or 6% on that $100,000, which is over and above the amount of the selling price. So they're actually selling it technically for more.
Yeah. And what's nice too is, well, there's that, and then let's say the building is not what we call bankable. So the building is, usually that's what we look at, is distressed properties that need a little bit of Jennifer's love. Not mine, no. It needs a little bit of love, so to increase the rents, fix it up, there's certain things that need to be done, and then the bank will lend on it. So that's where a VTB, vendor take back, or owner financing, or private financing is perfect. Because it gives you time, it's a higher interest rate, but it gives you time to fix the place, increase your rent, and make the building bankable so people can now...
And then you're technically like refinancing it after that.
Yeah.
But some people do even like a VTB for up to 100% of the purchase price if the owner isn't in a hurry to get his money right away.
Yeah, and that could also become a joint venture. So this is more advanced, but you could potentially partner with the owner. So that is a form of partnership where they give you a loan and then they get, legally you can't say guaranteed, but they get a fixed amount of income or interest while they could maybe do a joint venture and keep a stake in the building and a vested interest, and then maybe slowly sell their shares off. So for a portion of the profit or whatever it is. So there's many options to get creative with financing and seller financing.
Yeah, absolutely.